Starting 2026, you can transfer $15 million to your kids tax-free. $30 million if you're married. Miss this window and the IRS takes 40%. Here's why wealthy families are acting right now to lock in generational wealth. Hey, welcome back to lIHITRO Bank. My name is Adam. The One Big Beautiful Bill Act just changed everything for estate planning. Beginning January 1st, the federal estate gift and generation skipping transfer tax exemption jumps to $15 million per person. That's $30 million for married couples. And unlike previous tax laws, this one is permanent. No sunset, no automatic expiration. The scheduled drop to $7 million in 2026? Gone. Think about what this means. You can give $15 million to your children, grandchildren, or anyone else without paying a single penny in federal gift or estate tax. If you're married and plan correctly, you can shelter $30 million. Every dollar above that gets hit with a 40% tax. 40%. The IRS takes nearly half of everything over the exemption amount. Here's why smart, wealthy families are moving fast. Even though the law says permanent, that just means there's no automatic sunset date. A future Congress could always change it. Right now you have certainty. You know the rules. You know you can transfer $15 million per person. Locking that in now protects against future legislative changes. BNY Wealth says the biggest difference is certainty compared to the temporary framework on the 2017 tax bill, where families worried exemption might get cut in half. The annual gift tax exclusion stays at $19,000 per recipient for both 2025 and 2026. This is separate from your lifetime exemption. You can give $19,000 to as many people as you want every single year without touching your $15 million lifetime exemption. Married couples can combine to give $38,000 per person. That means if you have 2 married children and 2 grandchildren, you can give each of them $38,000 annually. That's $228,000 in tax-free gifts every year without using any of your lifetime exemption. But here's where it gets really powerful. Direct payments for tuition or medical expenses don't count at all. You can pay unlimited amounts directly to schools or medical providers, and it doesn't touch your annual exclusion or your lifetime exemption. Want to pay for your grandkids' college? Write the check directly to the university. No limits, no reporting required. Want to cover someone's surgery? Pay the hospital directly. Completely tax-free and unreported. J.P. Morgan Private Bank uses proprietary technology called Wealth Plan Plus to help clients quantify exactly how much they can transfer without jeopardizing their own financial security. This is critical. Just because you can give $15 million doesn't mean you should. You need to make sure you have enough left to fund your lifestyle, health care, major purchases, everything you'll need for the next 30 or 40 years. 2 families might have very different gifting capacities, even with similar net worth. One family spending $200,000 a year with no major planned purchases might be able to gift $10 million safely. Another family spending $1 million a year planning to buy a lake house might only be able to gift $2 million, even if their portfolio is 3 times larger. It's not about portfolio size. It's about what you need to maintain your lifestyle. Here's what money actually solves with smart estate planning. 40% estate tax erosion. Without proper planning, the IRS takes 40 cents of every dollar over the exemption. That's generational wealth destroyed by taxes. The inability to pass wealth intact across generations gets solved when you use these exemptions strategically. You can move appreciating assets out of your estate now. All future growth happens outside your taxable estate. For people who already use most of their $13.99 million exemption, in 2025, you get a fresh $2.02 million to work with in 2026. That's additional capacity that didn't exist before. For unmarried individuals with net worth under $15 million and married couples under $30 million, the likelihood of owing federal estate tax just dropped dramatically. But don't forget state taxes. 18 states still have estate or inheritance taxes. New York's exemption is only $7.16 million. If you live in New York and die with assets just under $30 million, You won't owe federal estate tax, but you'll owe $4.3 million to New York. State-level planning still matters, even with the higher federal exemption. The generation skipping transfer tax exemption also increases to $15 million. This lets you transfer wealth directly to grandchildren or even great-grandchildren without triggering extra taxes. Unlike the estate and gift exemption, the GST exemption isn't portable between spouses, so you need careful planning to maximize it. So what should you do right now? First, talk to your estate planning attorney and tax advisor. Review your current documents. Many plans were designed around the assumption that exemptions would drop in 2026. Those strategies might not make sense anymore. Second, calculate your true gifting capacity. Don't just guess. Use financial modeling to determine how much you can safely transfer without compromising your future. Third, consider moving appreciating assets out of your estate now. Real estate, stock in growing companies, anything likely to increase in value. Get it out of your estate today, so all future appreciation avoids estate tax. If this video helped you understand the 2026 estate tax opportunity, subscribe to this channel. We're breaking down exactly how wealthy families protect and transfer generational wealth. Comment and tell me, are you planning to use the $15 million exemption? Let's build lasting legacies together. See you in the next one.